Hello, Adem. Welcome back to F.A.C.E.
Hey, how's it going, Dale?
My trading warrior brother with the most voracious appetite I've ever known for knowledge about esoteric things in the financial markets. That's my description of you.
Well, I always appreciate it, and it's
So what's on your radar? We have this 1.9 trillion COVID relief. You want to share your screen, Adem? It's that green box.
Wait, hold on. I'm sorry, Dale. I hate to interrupt. Adem, hi. My name is Blake.
Yeah. How's it going, Blake?
Good. I was just looking at your Twitter handle. You're in Scottsdale. I'm over by Carolyn, so I'm in Scottsdale as well.
Wow, nice. Yeah, I'm up on I'm actually right by Carolyn too. I used to work at that hotel right when it got open, the Westin.
Oh yeah. Well, I actually live on the Cactus and 101. That's where I live, but I'm up in this area. So
yeah, I'm on Raintree 101. But yeah, we should definitely meet up sometime.
Yeah, let's do it. All right. Hey, nice to meet you, and thanks for being here. So I'm going to let you go.
Great, thanks, sir. Did you go to ASU? Is that why you were in Arizona?
No. My dad. I was born in Jersey, but my dad and my mom hated the cold.
Yeah.
So
okay.
They just, when I was like 5, 6, they took us out to Arizona, and just been here ever since.
All right. Okay, so you want to share your screen now? It's that green.
Yeah, let me get that going. Cool.
So we make friends here on Phase 2. Okay, the corporate bond market. Okay.
Oh yeah, this is just my site right now. Let me.
All right.
So yeah, I guess last time we talked, just to get trades out of the way. Last time we talked, I think the last 2 times we talked, I told you I was really excited on uranium, and finally got out of that trade. Those calls, after 2 years of expiring worthless, finally returned money. I got here's a chart of the Cameco, which now uranium's in like a 5-year breakout. I don't know if you can see the chart I'm showing. Yeah, so in the beginning of the year, you were able to, an investor, a speculator, could have locked in 1-year calls, when the stock was at like $9, and then finally at the end of the year, like with 3 months left until expiration, these things went up like 100%. So got very lucky.
Congratulations.
Yeah, it's
I'm not against luck.
No, yeah. See, a lot of people, like, when they ask me questions on markets or anything, it's always it's anyone's. At the end of the day, anything can happen. There's black swans lurking everywhere. So as long as you're positioned to let your upside run unlimited and your downside is capped, I'd rather be wrong 9 out of 10 times, losing a little bit of money, but have the chance of making 10, 20x returns, versus making a small consistent gain. Like the modern portfolio theory, it teaches everyone make 2-3% a month, but then once every year or two, you lose 25% of everything, or go bust.
Yeah. I remember last time you were on, you were also talking about taking some very long-term bullish positions out of the money in the dollar.
Yeah, so that's worked out really well. We talked, my specific plays were short the Swiss franc and the euro. And here right now, the Swiss franc year to date has gotten crushed after rallying everything with the reflation trade at the earlier. Well, it's still going on, but it's like I haven't seen the market believe something so fervently since when the Fed was tightening in 2018-19 and the yield curve inverted. Like everybody was like saying like, oh, yields are going to go like way higher, and yields today, they're going higher, but there was a good saying I've heard. It's not since 2008. It's not, or actually since 1980s. It's not that yields don't go higher. It's that they don't stay high long enough. Like they go up a bit and then they don't stay that way and they keep falling. Same with inflation.
You think it might be different here this time?
No, I really see. My opinion is, I have a friend of mine who, they're they're like, how do you not see inflation coming? Like, look at input prices, but we still haven't seen it really trickle in yet. And I mean, besides food and stuff, but the thing is, there was bad harvest this year, and there was limited supply of food because of the farming
Pandemic.
there's supply bottlenecks with the pandemic. So if you
Yeah.
in Peter Bernholtz's book, Monetary Regimes Throughout History, it's a great book. Pull it up on Amazon. It's a must read for.
Okay. And that's a great endorsement because Adam's read all of these.
Yeah, that's a great book. I highly recommend it for. I think inflation is something that's extremely tricky, like reflation, inflation, deflation, price waves. This book, Monetary Regimes and Inflation, History, Economic, and Political Relationships. I mean, it's kind of pricey right now, so I don't know. Maybe find a PDF
Find
online,
it in
but
paperback.
yeah, like, I thought it was worth the money, but the author, he basically says that he doesn't consider like food and other things as inflation because that could, a bad harvest, and throughout the last 1,000 years throughout history, like, Malthus's Malthusian trap, it used to be like food was the greatest thing standing in the way of standard of living, because back in over the last 1,000 years, if there was too many mouths to feed, like usually, so the three great deflators was war, plague, famine. So one bad crop failure or one big war would like cut the population, and all of a sudden you have standard of living, real wages rising because you have so much, output, like in the world you have so much land, but then like all of a sudden 20% of the population dies in war, or like the Great Plague was a big one. It rose real standards of living because wages went up because there was less, workers. So workers were able to pick their wages better. There was, food, etc. So throughout history, main price and waves came with food. And what's strikingly is last time I think we've talked about this twice already, so I won't stick too much on it, but I think it's so important that people understand the great inflation waves. In this book, The Great Wave by David Hackett Fisher, this book right here, when I got into the like macro world back in like, 2012, my like old mentor told me to read this book, and it shows like interest rates for the last 1,000 years and how in Britain they were down to like 2.5% in the 1700s. But I thought the real meat of this book is it shows the four major price waves in history, and it's basically each time it started up until the 1800s when the first industrial revolution occurred. There was more technology and advancement and like goods being made relative to people being born. So back then, people being born was like the bottleneck. If you had too many mouths to feed, if war wasn't happening, people would procreate more, and then there would be demand pull inflation. Remember, there's three types of inflation. You got supply side. So like if oil prices dropped 50%, you would see an equivalent, or not equivalent, but a drop in the gasoline price or input at your, whatever business, your transportation business. Yeah. So that's the supply side. So 1970s inflation mainly was driven by the supply side because, the Saudis did the oil embargoes after the Suez Canal, the issue with, Israel. But, and then there was also commodity shortages because of years of post-war demand issues. But then all of a sudden you got all this new supply come online, and then, not to mention on the demand side in the 1970s, you had unions, very strong unions. You had standardization. Japan and Germany beat out basically Nissan and Volkswagen were overtaking, Toyota, Dodge. That's when the U.S. car manufacturers really lost their luster. When standardization, post-World War II standardization, a decline in creative destruction. Alan Greenspan's book, Capitalism in America, does a great job really showing the bottlenecks that happened in the 70s, the 50s to the 70s that really led to inflation. And while breaking from the dollar did help, the U.S., it's not that inflation wasn't happening, even while we were on the dollar standard, the Bretton Woods, the U.S. was exporting that inflation abroad. So they had no choice but to break from gold. So post 1970 though, like end of 1970s, we've been in the age of surpluses. Like, so a great chart to really like highlight this is do I have it up here?
Can I interject that, a lot of people are very bullish, especially the grain markets. They've had tremendous runs, Adem.
Yeah.
And you were talking about that inflation. The big push used to be before we were, now we're past the industrial revolution. We're in the technological revolution.
Mm-hmm.
What is this? The fourth turning, whatever that book was.
Yep.
So now we have grains really exploding. I mean, the beans, went to $13, $14 from $8. I mean, you have doubling of grain prices in the last year or so. Could that be the main suspect for another wave of inflation? And people already talking about that there could be food insecurity for the world. I mean, most of the world, a lot of the world already has it, but advanced Western economies haven't had that type of food insecurity. Although there are families getting in food lines due to the pandemic. The grains, long-term charts, monthlies, weeklies look pretty constructive.
Yeah, so that's definitely true. And food prices, have started going higher. I think they're at like a high, like a 5, 6 year high. But also a lot of that is driven by, remember in 2019, China had that big hog culling because of the African swine flu. So now
Right.
they have to import corn, which was already in supply shortages because corn prices had got crushed between 2018 to basically before the crisis. So farmers weren't planting as much. And yeah, like you said, there already were having grain shortages happening. So, it's like Jim Rogers used to say, like low prices are the cure for low prices and high prices are the cure for high prices. We're in like this area of surplus. Food is, yeah, like this year, bad harvest plus extra demand from China, especially with them rebuilding their grain supplies, and they were rebuilding everything. But the thing is, it was short lived. China's already tightening, so it's hard for me to really see like this chart I pulled up. It's capacity utilization of manufacturing, and if after the 70s, as you can see, it's just been pretty much like a slow decline, with big dips and rebounds, but it's kind of been like a downtrend after peaking out in 73, 88. Now it's back down to 74. Basically, there's a ton of excess capacity that can come online. So when I see people talk about inflation, I think to myself, we're in a world where people are hoarding the dollar. Like demand for reserve has increased exponentially since the Asian contagion crisis in the late 90s. Like I think world outstanding dollar liabilities, like claims, was like 900 billion at that point. Well, it's at like 7 trillion today, and it's only gotten more since 2008 because countries like China, they're like, hey, I don't want that problem. I want to have a lot of reserves. And what sucks about being the US dollar, they say being the reserve currency is an exuberant privilege. And it does come with its perks, as if you can, you make the sole money in bonds that the world needs. But at the same time, the US has to constantly run deficits. Imagine if they said, hey, we're going to come out and balance the budget. How would, so by the, this is what, Robert Triffin said in the 1960s why Bretton Woods would break. It became known as the Triffin dilemma because he said the U.S. can't focus on its domestic policy of running a budget surplus, because if they weren't running deficits, they wouldn't be exporting dollars into the world. We have to buy more than we consume to put dollars in the world for everyone to have those dollars. Like, what do people want to save? How would China and Japan and Germany, et cetera, have dollars liquidity to purchase their goods if they didn't have dollars? So the US has to run deficits. And in Michael Pettis' recent book, Trade Wars or Class Wars, which I mentioned last time, that was like my favorite book of 2020. He shows how there isn't a shortage or a lack of demand for US dollars, and I think that's why a lot of people who are expecting inflation, or they're expecting, like, yes, US fundamentally, it's a mess. Like, does it deserve a weaker dollar? I mean, you could, yeah, I mean, I think so. But that's not like the European Central Bank and the Bank of Japan and the Bank of England or the PBOC, Chinese central bank, are going to allow that to happen. Macro isn't just thinking about your currency. It's, you have to think about every other currency in its own system with its own feedback loops, pushing, one, getting aggressive versus the other one, taking away, etc. So, we've seen the dollar rally. And I think, yeah, you and I last talked, we weren't going to be surprised if we saw the dollar rally, after the new year. And, we've seen that. We've seen it after hitting, lows recently. It's like shot back up. And
89.20. A lot of people were looking for 88. It did not get there. So 89.20 looks like the bottom. Then we rallied, pulled back to 89.75, and we're pressing the 92 level here.
Yeah.
So
and I think it could go higher just because, the more advanced markets have gotten, the more fast reacting they've gotten, and everyone's pricing a distant future in today. Like, for instance, they keep saying we're going to get inflation, but the CPI last month barely budged. It didn't even, it's not like these input prices happened yesterday. Input prices, because of supply bottlenecks from COVID, have been happening for months. But, the CPI is still, relatively tame. And could there be inflation? Absolutely. But when I think of inflation, I'm looking at like what Peter Bernholz, the author of that book, said. And it's not like suddenly we get 3% inflation. I mean, you're talking about 1% higher than the Fed's target after years of low inflation. And I also think there is inflation, but the thing is, in the long term, it adds up. Like you and I talked about once, this is what happened in those 4 great wave cycles. Mainly, like, for instance, in the 1500s, new money supply coming after Columbus's raiding of, the New World. They brought a bunch of silver from the New World over. That new silver inflow over that 100 years had prices rising from added silver about, it was about 2% a year per average. And that doesn't seem like a lot. But if you're a consumer, after 100, these price waves went for 50, sometimes 75 to 150 years. And, over time, that 2% adds up. It's like when you go to the store, it's not like I see, I'll notice maybe beef is a little more expensive, but it's not like every month I'm going there, prices are doubling 5% or, going up 5% each month. It's,
what do you,
know what I mean?
What do you think of this statement? Someone else that I've interviewed, very, insightful guy, said, when I asked him about the dollar, he said, the dollar can't collapse until it explodes, meaning that there's going to be, an explosion of the dollar. One of these guys saying, maybe that he didn't get price levels, but the explosion to me would mean like, the Dixie being 120. Okay, I know some super dollar bulls that are looking for even higher numbers, and he said that has to happen first before what everyone's talking about now can happen. What are your thoughts?
I personally don't. Anything can happen, and I always think
Right,
it happens
everything
the
and
least
anything.
way we expect it. But it
Right.
could happen. It absolutely could happen because, like I was saying, I get the inflation argument, and I do think there is inflation, and I do think it's eating away at purchasing power. Even if it's 1% a year over a decade, that adds up. That's 10% of your income. So there's clearly creeping inflation. But this idea, like that the dollar is, it's going to be hyperinflation. It's just like we're saying, there's huge demand for dollars abroad, and China doesn't want to be the reserve currency. Why would they want to? They run surpluses. Imagine them having to sit there and provide liquidity for the world, running deficits. And that's what everyone thought they were going to do post 2008. But sorry, yeah, back to your question. Yeah, I mean, I do think that could happen. I think that the dollar could, as some crisis happens and there's just overwhelming demand. Like that's the problem today with the dollars. That's the Fed's not. It's that there's too much savings in the system. There's a glut of savings everywhere, holding rates down. You know what I mean?
Okay.
It's not like, oh, we're having a shortage of it. The Fed's printing too much. It's that there's literally, there's like so much of it that there's not enough. There's the law of diminishing returns. Joseph A. Tainter wrote one of the best books I've ever read in the 90s that really opened my eyes. It's called The Collapse of Complex Societies. And the 2 key themes in that, in every collapse, is the more complex a system becomes, the more fragile it becomes. And 2, the law of diminishing returns is an important factor to focus in, because with whether it's energy, whether it's industrial capacity.
Whether
China
it's
today.
QE, I mean, a lot of people know that for every, the bang for the buck that you get on QE, it's not as
Exactly.
potent as it
Perfect
used to be.
example. Yeah.
Okay.
And same with China. So they're building these, and that's what Michael Pettis points out. And he says half of China's economy isn't consumption like the US. The idea was post 2008, like, hey, China, you're going to take over, you're going to be, carrying the world. And that was the big story in the 2000s, which really pulled commodities. And I've been bearish gold this year only because, and I own physical gold. I've owned a ton of it. And I have a friend who's like, oh, you're crazy. Like, with prices going up. But I got out of gold this year after 2000 just because I said, you have central banks for the first time in a decade being a net seller of gold. They're the marginal buyer. A central bank buying is the biggest demand for gold at the market. And not
You
only are they not
liquidated your
buying,
physical on that too?
no. I'm holding
Oh,
physical.
okay.
That's just like my rainy day thing. I bought that
Okay.
in 2013 when I thought the world was going to end when I was younger, and
All right.
I'm just holding it as like an insurance policy. I'll never
Got it.
sell my physical unless,
Yeah.
but a lot of people don't realize, also I see people say like, oh, we have, EMs like with debt going higher and stuff. I'm like, yeah, but by law, when you repay debt, I can't go to my debtor and say, here's gold. He'll say, sell your gold, then pay me in dollars, So no matter what, there always will have to be demand for dollars legally, unless the whole system obviously changes. And, could that happen? Absolutely. But it's not like the US would be in the same boat. It's like every country right now is in the same boat, trying to steal growth from each other. And now the euro. So for instance, with the dollar going up recently, you can make the argument, is it the dollar that's going up, or is it the euro, going weaker? So you have the ECB competing against the Fed. So you can't really say, oh, just because the US fundamentals suck, the dollar will go weaker. It's, hey, the European central banks or the Eurozone or Japan's or whatever, every other country's fundamentals suck even worse. So it makes the dollar relatively look good. That's the only reason I was long the dollar over the and short the Swiss franc and the euro. I just think these other countries.
Okay, so how about now, Adem? Anything new that you're looking to do that you have on your radar? Still favor the long side of dollar long term. Anything still like uranium, but you'd buy a pullback?
So interesting with
chemical?
uranium, the price of uranium actually has been falling, the spot price. So I'm it's so hard in this market today. Like it's just with everything is so bloated, just liquidity sloshing around, pushing prices up. Like
people are paying $500,000 for a tweet. They're buying tweets.
Yeah, it's crazy. Like the Wall Street Bets thing with GME, and there's one second. Sorry about that. It's crazy. Like you're having so much liquidity sloshing around. And remember, a lot of people don't realize that there was always the marginal seller for like GME. Like let's say there's a couple 100 million shares trading on that company, but on any given day, there's probably only a couple million shares traded. So you have probably 95% of the total stock sitting in people's brokerage accounts. You don't have people every day selling every account. You have like big institutional holders. Once those people decide to sell, once there's enough, even that's how panics are driven. It's just when you have a little bit more marginal selling on that day than marginal buying, prices tumble. So
tell me if I'm right. Tell me if I'm right, because when I ask you these questions, you're going to explanations, and I know you. When you have conviction, you just say what you're doing. It's okay to not know and kind of be flat and not be aggressive in anything when the waters are murky. Is that kind of where you're at? That's what I'm sensing.
Oh yeah, I'm always at that point. It's I mean, I make like 5 trades a year, and I hope, like the uranium one, I hope I can get 20 times, 20 times my money, and then I'm good for like 5 years. Even if every trade after that sucks.
Yeah. Do you have anything on like that now?
So I really think, just like in times of murky waters, I just look at the expected value, which is magnitude over probability, meaning look for scenarios that the market's not pricing in, that if it does go wrong, you can make for instance, if everyone thinks bonds are going to go, yields are going to go higher, it's priced in at this point. So like you could be right with the crowd, but I mean, it's already priced in. So if it does happen, you don't make as much. Or you could bet the other way, and let's say something goes wrong, and things happen much, people are wrong. The crowd is wrong much more, often than people realize, and you can make 20, 1 through 10 X returns.
Yeah, isn't it a perfect example? I mean, it was only a year ago we were talking about the U.S. going to negative rates, right? And look what happened. And now everyone's talking about yields have bottomed, and there's nowhere for them to go but up. So, we've done a 360 from the negative yield scenario to higher yields. So what you're saying is there could be a bet on the long side of bonds in the coming.
Yeah, that's what I would be. Look, I'm getting ready to make a trade because another chart I have up here, I was just, before I get out of your hair, I don't mean to talk your ear off, but if you look at real personal income excluding transfer receipts, meaning stimulus, I mean, it's still below, and it's going down recently, actually. So income, besides getting those payments, has been declining. So wages not doing anything. It's really hard to see inflation besides temporary supply shocks. That's not inflation. Just like we said, like supply issues happening, markets adapt, and there's a lot of excess capacity that could go online, and the point is, for anyone listening, from when you read a lot of history, you see how hard it is to get consistent inflationary pressures in a world of surpluses and globalization, because you could just import the deflation. So that's what I'm sticking at. I'm waiting for the market to go overcrowded, which it is at this point. I would rather bet going long-term bonds soon.
And how about getting short equities?
See, that's always tricky, just because equities don't even follow fundamentals at this point. So while I agree in their high, I know.
Look, I bet against them.
Yeah. So I'm still.
I know what it's like.
Yeah.
All right. So Adem, again, thank you so much for being here. I love that's really a nice saying: magnitude versus probability.
Yeah, that's called expected value. Expected value analysis. It's a great thing. Magnitude payoff over probability, which is frequency. Okay,
that's great. All right. Well, thanks again, my trading warrior brother, for coming here and sharing your views with us. And I'll send you a DM on Twitter, and we'll get you back here. And really, lots of luck on your. I hope all your trades have a huge magnitude payoff.
I appreciate it. And sorry to all your viewers. I didn't see the chat thing up. If you guys want to private message me your question or anything on Twitter at Radical Adem, feel free, and I'll try to get back to those.
Yeah,
I just saw those pop up.
And it's Radical Adem, ADEM. It's not Adam, it's Adem.
Yeah.
ADEM. To get in touch, and what a great follow. Follow this radical Scottsdale guy. All right.
I appreciate it, Dale, and everyone else.
All right, buddy.
Great, everyone. Have a good day.
Take care. All right, everyone. I'll see all you guys for Turnaround Tuesday. Thank you, Brock, Monica. I'm glad you enjoyed Adem. I do. I feel enlightened every time I talk to him. And that's going to be a wrap. And you could join everyone for the Morning Edge. Thank you, Nuno. I'll let Adem know in 15 minutes. Adios, everyone. You're welcome, Monica.